Yes, so this is the topic number 6, and basically the topic is on income taxes. And basically what I've said is that our main interest here is to look on how we determine and also account for what we refer to as the deferred taxes. But maybe first of all, we can remind ourselves what are income taxes, or what is income tax. Income tax generally is the tax which is payable by the company or an entity to the government based on the reported profit. Because generally what we know is that if today you have incorporated or basically registered a company, that company is recognized to be a legal entity. So that company has the same status just like you as an individual, and therefore that company has to pay tax to the government at the end of each year. And actually that tax payable by the company is always based on the taxable profit. So therefore income tax is that tax payable by the company to the government based on the reported profit. And also, if you can be able to recall in intermediate level, we are told that this particular standard here, that is International Accounting Standard number 12, it basically provides some guidelines in terms of how entities should determine and also account for two types of income taxes. So the first type of income tax is what is known as the current tax. And number two, we have something called the deferred tax. The deferred tax. Now, at this level, our main interest is basically to look on how we account, how we determine, and also account for the deferred taxes with that aspect of group account. But maybe we can also remind ourselves what is the current tax. Current tax, generally, this refers to the actual amount of tax which is payable by the company in respect to a certain accounting period, and this particular tax here is always based on the taxable profit. So therefore, two things, that the current tax is what is the actual tax payable to tax authority, For example, in Kenya, when talk about the tax authority, we are referring to KRA. So companies must pay tax to tax authority, and actually we are saying that this actual tax, which is payable by companies, this one is based on the taxable profit. This one is based on the taxable profit, and actually we know from PFT, from taxation, to determine the taxable profit of the company. Generally, we take the taxable incomes of the company, and then we only rest the deductible or the allowable expenses of of that company. Then we get now the taxable profit, and then we subject that to the rate of 30%. So meaning that this particular current tax here, current tax, this one is computed by taking the taxable profit times what? Times the tax rate, of which we know that resident companies should pay tax at the rate of what? 30%. So this is something already we know from what you have covered in PFT, what you covered in financial reporting and analysis intermediate level. But basically at this level, that is not our main interest. Our main interest, or basically our main focus here, is the second type of tax here, and that is what is known as what? The deferred tax. So first of all, maybe we can just remind ourselves on what is the deferred tax. So deferred tax, generally, as the name suggests, this is basically a tax which will be payable by the company in the future, or in other terms, this is the tax recoverable by the company in the future, because we have both deferred tax liability and deferred tax asset. Deferred tax liability is that tax payable by the company in the future period, and the deferred tax asset is that tax which the company is supposed to recover in the future period. So generally, we can say that this is a tax. This is a tax which is basically payable or recoverable in the future. Recoverable in the future. So why do we have deferred tax or basically that is deferred tax asset or deferred tax liability. Deferred tax asset or deferred tax asset or deferred tax liability, or generally the deferred tax, this arises as a result of the difference between two profits. Because it is also important for you to know that in a business, we have to profit. As an accountant, the moment you have prepared financial statements, specifically the income statement, you take into account all incomes of that business or all incomes of that company, then you less all expenses. Now, that profit which you get is known as an accounting profit. But when computing the tax to be paid, we know that that tax you computed based on the taxable profit. So therefore, there are two types of profit. We have taxable profit, and also we have the accounting profit. So therefore, deferred tax generally arises as a result of the difference between deferred tax, not deferred tax, sorry, the accounting profit and the taxable profit. So therefore, we can say that this arises due to the difference between accounting profit, of which this accounting profit is also known as the profit before tax, accounting profit, and the taxable profit, So therefore, generally, if these two profits are different, accounting profit and the taxable profit, then this automatically will give rise to something called a deferred tax. A deferred tax. Now, before we proceed to the other concept, what do you mean by the taxable profit? A taxable profit, generally we say, is that particular profit which is computed based on the existing tax laws, based on the current tax laws. So meaning, for example, when computing the taxable profit, we take the taxable incomes, because there are those incomes of the company which are not supposed to be taxed. We take the taxable incomes and then we less the allowable or deductible expenses. There are those particular expenses which are incurred by the business, but when computing the taxable profit, they should not be deducted from the total incomes. And this is something you know from PFT. Good examples of maybe non-deductible or disallowable expenses include, for example, depreciation of assets, things like maybe fines and penalties, and things like maybe the personal expenses. If, for example, there are some personal expenses and so on, all those are disallowable expenses. So therefore, taxable profit is that profit which is computed based on the existing tax laws. But on the other hand, when we talk about the accounting profit here, we say that these are profit which is computed using the accounting policies which have been adopted by the business. The accounting policies here, we are talking of things like methods of depreciation. How is the company depreciating the asset? Is the company depreciating the asset using straight line or basically reducing balance? So therefore, this is the profit computed using the accounting policies adopted by the business, and also by applying various accounting standards like IAS, like IFRS, and so on. And therefore, we are saying if these two profits basically are different, that will give rise to deferred tax. Now, the difference between these two profits, that is the difference between accounting profit, which we are also referring to as the profit before tax, and the taxable profit. So this particular difference, the difference between these two profits, can actually be broadly classified into two categories. One, we have something called the permanent difference, and number two, we have something called the timing difference. So the difference between accounting profit and taxable profit can be broadly classified into two: permanent profit and the timing difference. So what do you mean by the permanent difference? Permanent difference. So this is the difference between these two profits, accounting profit and taxable profit, which arises as a result of taking into account certain items of incomes and expenses only in the computation of accounting profit. Only in the computation of accounting what? Profit. So therefore, this one arises as a result of taking into account certain items of incomes and expenses only in computation of accounting profit. So mean that those items, they are not used in computation of taxable profit. And good examples of such items include depreciation. We know in computing the accounting profit, depreciation, you account for it as an expense. But when computing the taxable profit, we know depreciation is a disallowable or non-deductible expense. You don't take it into account in the computation of what? And the taxable profit. Number two, we also have things like fines and penalties. If the company didn't comply with some laws, like the company didn't file the tax returns on time, the company never paid, for example, the installment taxes on time, maybe the company was penalized by KRA. So those fines and penalties, when computing the accounting profit here, when preparing the income statement as an accountant, you account for them as an expense of that business. But we know when computing the taxable profit, are those expenses deductible or allowable? No, they are not. So therefore, those expenses are not taken into account in the computation of a taxable profit. So that automatically will make the two profits to be different. And actually, we are saying that difference is known as what? The permanent difference. Now, on the other hand, we have timing difference. What is timing difference? Timing difference also is the difference between these two profits. And actually, even before I explain this one, there is something I think I've forgotten about permanent difference. So permanent difference basically makes the accounting profit and taxable profit basically to be different, just in or make these two profits to be different, in a certain financial year, and actually that difference do not reverse in the future. You'll be able to understand what you mean by reversing once I explain this one, timing difference. So for example, if maybe the company was computing the accounting profit of 2024, and during this year, the company, for example, was required to pay some fines and penalties for not filing the tax return on time. So it only means that the accounting profit and taxable profit will be different in the year 2024, because that is the only year the company has been required to pay what? Fines and penalties. So if the fines and penalties are 2 million, then the difference between accounting profit and taxable profit may be 2 million. But that difference, we say, does not reverse in the future. So therefore, this particular difference between, or this difference here, permanent difference, it does not give rise to deferred tax. So therefore, that is important for you to know. So that this difference here, because it does not reverse in the future, it does not give rise to deferred tax. And therefore, when computing the deferred tax, we don't consider this one. We don't consider what? The permanent difference. Now, let's move to the second type of difference, timing difference. Timing difference, on the other hand, is the difference between accounting profit and taxable profit, which arises due to what? It arises due to taking into account items of incomes and expenses in the computation of both accounting profit and taxable profit, but in different accounting period. Like in this case, you can be told a company incurred a certain expense in the year 2024. So this particular expense was accounted for, or basically was accounted for in computing the accounting profit of 2024, but this expense should only be treated as allowable expense maybe in the year 2026. What does that mean? It basically means that because this expense will only the company will only be allowed by the tax authority to treat it as allowable expense in the year 2026. When computing the taxable profit for 2024, that expense will not be considered as allowable expense. So, but in 2026 now, when the company is computing the taxable profit, that is the only time the company will take into account that what expense. So you can see this is an expense incurred by the business it was used in the computation of accounting profit in the year 2024 and used in the computation of taxable profit in which year? In the year 2026. So therefore, we say that the difference between accounting profit and taxable profit, which occurred in the year 2024, then we'll have to reverse in the year 2026 when this particular expense is taken into account in the computation of taxable what? Profit. And therefore, this particular difference here is the one which give rise to deferred what? Is the one which give rise to deferred tax. Is the one which give rise to deferred what? To deferred tax. So therefore, generally that first of all, what is important for you to know that this difference between accounting profit and taxable profit can actually be broadly classified into those two what? Into those two categories. Now, next, I want us to look on before we look on how we compute the deferred tax and so on. First of all, I want us to look on definition of various terms. Definitions of terms. So basically, these are some terms you're going to come across when looking on how we account for what? For deferred taxes. So the first term here is something called the carrying amount. Carrying amount. Carrying amount. So in this case, what do you mean by carrying amount? Carrying amount generally, this is the value at which an asset or even a liability is recorded in the statement of financial position. Very simple. So we say that this is the value, is value of assets or liability in the statement of financial position. So the value at which an asset or even a liability is recorded in what? In the statement of financial position. In other terms, you can say it is the book value. It is the book value of asset or liability. So that value at which an asset or liability will be recorded in the statement of financial position. So we also have, or the second term, that is the number 2, we have a tax base, abbreviated as TB. Abbreviated as TB. So tax base, on the other hand, this is the value of an asset or liability for tax purpose. Value of an asset or liability. Value of assets or liability for tax purpose. For tax purpose. For tax what? Purpose. In other terms, this is basically the value which is taken into account when computing maybe the amount which will be taxed or basically the amount which will be allowable for tax purpose. A good example, if for example a company own an asset, and maybe that asset has been sold. The company own an asset, and basically this asset has been sold. So when computing the amount to be taxed, generally what we do is that we take the sales proceeds. But in taxation, we don't less the carrying amount or basically net book value, because in financial reporting, when computing the gain or the loss on disposal, once an asset has been disposed, we take the sales proceeds minus what? The net book value or the carrying amount to compute the gain or loss on disposal. But in taxation, we don't use a net book value or carrying amount. In taxation, we use something called the written down value. The written down value. And actually, I hope you can be able to remember what is the written down value of an asset. It is basically the cost of the asset minus the capital allowances. Capital allowances, we know that these are computed using the tax laws. So therefore, this written down value is the value of this particular asset for tax what? For tax purpose. So this is the value of an asset or liability for tax what? Purpose. So the other term is something called the temporary difference, abbreviated as TD. So temporary difference, or basically TD, this is now the difference between these two values, carrying amount and the tax base. So if the company own an asset or basically a liability, and these two values happens to be different, the carrying amount and tax base happen to be different, then that difference is what? Is temporary difference. So therefore, this is the difference between a carrying amount and the tax base of assets or what? Or liability. So any difference between those two values. So and in this case, we have two types of temporary difference. So we say that TD, which is temporary difference, can either be. So we have two types of this. Number one, we have something called the taxable temporary difference. Taxable temporary difference. And number two, we have a deductible temporary difference. So before I move to number two, maybe I can first of all explain what we mean by taxable temporary difference, abbreviated as TTD. So taxable temporary difference, basically this is a temporary difference which give rise to amount which will be taxed in the future once the company sell an asset. Once the company sell what? An asset. So it's basically a difference between carrying amount and tax base of an asset, but you're saying that this will give rise to amount to be taxed in the future once the company either sell an asset or basically settle a liability. So therefore, this one, it give rise to amount taxable or to taxable amount in the future. To taxable amount in the future, whenever the company sell an asset, will basically settle a liability. And in this case, a temporary difference is said to be taxable. A temporary difference is taxable, whereby the carrying amount of the asset or liability basically exceed the temporary difference. So once the carrying amount is more than tax base, then that is a taxable temporary difference. Is a taxable temporary difference. Then from there we have the second type of temporary difference, number two, and that is the deductible temporary difference, which is abbreviated as DTD. So this is a type of a temporary difference which give rise to amount which will be deductible or amount which is allowable in the future once the company sell an asset or basically settle a liability. So we can say that this one give rise to amount deductible in the future. So we know what we mean by this amount which is deductible. So this is an amount which will be treated as allowable expense or deductible expense in the future once the company sell an asset or basically settle what? A liability. In this case, now a temporary difference is deductible, or we have deductible temporary difference whereby the carrying amount of asset or liability is less than tax base. So that temporary difference whereby the carrying amount is less than tax base is what? Is deductible temporary difference. So therefore, you have those two types of temporary differences. The other term we also need to define here is called the deferred tax assets. The deferred tax asset. And a deferred tax asset, as the name suggests, this is a tax which is recoverable by the company in the future. A tax recoverable in the future. Tax recoverable in the future. And actually, these or basically deferred tax arises. Deferred tax asset arises due to something called deductible temporary difference. So we can say this arises due to deductible temporary difference. So meaning that if at the end of the year the company has a deductible temporary difference, then this will give rise to deferred tax asset. And therefore, how do we compute the deferred tax asset, abbreviated as DTA? Deferred tax asset, therefore, is equal to deductible temporary difference, is equal to deductible temporary difference times the tax rate. Times what? The tax rate. So this particular formula is very, very important here. How we compute what? The deferred tax asset. We take the deductible temporary difference, we multiply that with what? With the tax rate. We multiply that with the tax rate. So the other term we also need to define here is something called the deferred tax liability. Deferred tax liability, DTL. So a deferred tax liability, on the other hand, this is a tax which is payable by the company in the future. Now, the direct opposite of tax recoverable. So it is a tax payable by the company in what? In the future. So this is tax payable in the future. Tax payable by the company in the future. And actually, this deferred tax arises due to this taxable temporary difference. It arises due to taxable temporary difference. It arises due to deferred tax, not deferred, sorry. It arises due to taxable temporary difference. And therefore, how do we compute this amount of deferred tax liability? So the deferred tax liability in this case, therefore, is equal to deferred tax liability is equal to taxable temporary difference, and then we multiply this with what? We multiply that with tax rate. So also that particular formula here is also very, very important in terms of how we compute that deferred tax liability. So these are basically some of the terms you must be in a position to define. You may come across a theory question whereby you're required maybe to explain some of these particular terms, like maybe what is temporary difference, maybe different types of the temporary differences, and so on and so on. Yes, so next, I want us to look on the various approaches which can be used by companies in computation or basically determination of the deferred taxes. So let's look on approaches of computing deferred tax. Computing deferred taxes. Now, in this case, we have two approaches which a company can use to determine the amount of deferred tax. That is either deferred tax asset or deferred tax liability. So the first one is called the income statement approach. So under the income statement approach, the deferred tax is actually determined using the timing difference. And actually, a timing difference we have said is the difference between the accounting profit and taxable profit. So that is what is important for you to know here, that under this approach, deferred tax is computed using timing difference. Under this approach, deferred tax is computed using what? Using timing difference. Now, what you have to recall is that timing difference is the difference between accounting profit and taxable profit. Difference between accounting profit and taxable profit. But now, this particular approach here is not recommended for use by IAS 12. In fact, at this level, or basically if you go through the past papers, the questions which have been tested from this topic you'll not see a question requiring you to use the income statement approach. So all the questions examined at this level, they basically require the computation of deferred tax using another approach we are going to see known as balance sheet approach. So therefore, you can say this method is not recommended. This method is not recommended by the International Accounting Standard number 12. It is not recommended. So number 2, we have the balance sheet. Balance sheet, or in other terms, we can refer to this as statement of a financial position approach. Statement of a financial position approach. Statement of financial position approach. Now, under this particular approach, number 2, deferred tax is now computed or is computed using the temporary difference. You have to recall that temporary difference is the difference between carrying amount and tax base of asset and liabilities. So therefore, we can say under this approach, deferred tax is computed using what? Is computed using temporary difference. Is computed using temporary difference. Temporary difference, we have said, is the difference between accounting profit and the taxable profit. And actually, this is the method or the approach which is recommended for use by IAS 12. So therefore, this is the recommended approach. This is the recommended approach. The recommended approach by International Accounting Standard number 12. In fact, if you check on now all the questions tested in the paper for AFR, in the most recent sittings, usually the examiner will require you to compute the deferred tax using this particular approach. And actually, under this particular approach, you'll be given various items of asset and liabilities. What you're required to do is to determine their carrying amount, to determine their tax base, and then you get the difference between those two values, carrying amount and tax base, and automatically that difference is what we are referring to as what? The temporary difference. The temporary what? The temporary difference. The temporary difference. So therefore, that basically the two approaches which can be used by companies in computing this particular deferred tax. That is the income statement approach, and also the income statement approach, and also the balance sheet the balance sheet approach. So I think with that we can be able to proceed and look on our question, because generally, remember, this is something you did. You covered a similar topic in the lower level. So what I want us we do is basically maybe go straight to a question. We can start with maybe a simple questions. Maybe the additional concept you have not yet discussed. Maybe I'll be able to maybe explain some of them as we look on some questions from the past paper. So you take out your past papers, and actually I want us to start with a very simple question, which is here. Yes, we are going to start with a question for which sitting. There was a question, I think, which was tested in the sitting of 2017, or let me confirm. Yes, so I want us to start with this question for November 2019. November 2019, which is question number 5. 5 what? 5B. November 2019 5B. That is a question I want us to start with. Basically, is similar to, I think, a question which was examined in financial reporting and analysis. Yes, November 2019. And this is a question number 5, boy, 5B. 5B. Five B. So once you get the question, let me know so that we go through it. Once you get the question, let me know. November 2019. Question 5, boy. 5 boy. 5 boy. 5 boy. Are you there? 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 Yes. So the question reads, Mafuta Limited had a deferred tax liability as at 1st of October 2018 of shillings 400 million. For the purpose of preparing financial statement for the year which ended 30th of September 2019, the following additional information is available. So you're given number 1, and you're told the company has available for sale financial asset with a carrying amount of 80 million and a financial asset at fair value through profit and loss of shillings 40 million. So both financial assets had reported losses in the fair value of shillings 8 million 8 million each as at 30th of September 2019. Number 2, inventory is shown at the road of cost and net realizable value. The cost is shillings 200 million, while the net realizable value is 120 million. Number 3, receivables had a carrying amount of shillings 2,000 million after making allowance for doubtful debt of 80 million and an exchange gain of shillings 160 million, which is not yet realized or which is unrealized. Both the allowance and the exchange gain are not allowed for tax purpose. Number 4, trade and other payables are stated at 3,600 million after making provision for discount of shillings 40 million. Number 5, property, plant and equipment had a carrying amount of shillings 4,800 million and a tax base of 4,000. And then you're told some land and buildings were revalued upward by shillings 2,000 million during the year which ended 30th of September 2019. 6, intangible assets consisting of trade licenses being amortized over 5 years had a carrying amount of shillings 240 million. And then you're told this was allowed for tax purpose in full 2 years ago. Number 7, you're told to assume a tax rate of 30%. So what are we required to do? Roman 1, compute the relevant temporary differences. And Roman 2, we are required to prepare the journal entries to record the changes in deferred tax liability. So automatically we're going to start with Roman 1 of that particular question, whereby we are required to compute the relevant temporary differences. The relevant temporary differences. Remember, in this case, temporary difference. This we have abbreviated this using TD. TD, temporary difference. Temporary difference. So the first thing which is important for you to remember here is that this temporary difference, we have said that this is equal to carrying amount of the asset minus the tax base. In other terms, the temporary difference is the difference between carrying amount and what? Tax base. And actually, you have said we have 2 types of temporary difference. We have taxable temporary difference and deductible temporary difference. Now, if you come across a question and you're required to compute temporary differences, I hope you can see in note number 1 up to note number 6, we are given various items of asset and liabilities. So how do we go ahead and compute these temporary differences? So we have basically, we can prepare something called a schedule of temporary differences, or just come up with a table. The first column here should be for the various items of asset and liabilities you are given. You should have a column here for those items of asset and liabilities you are given. Then the next column should be for carrying amount. Then the next column should be for temporary difference. And then the last column here should be the difference between these two values, which automatically will be what? The temporary difference. So therefore, we need to have those two columns here. So the first column here will be for the various items of asset and liabilities given from note 1 up to note number 6. We have the next column here for carrying amount. We have the other column for tax base. And the last column here for the temporary difference. The temporary difference. And also, I hope you can see the figures we given from note 1 up to note number 6. Those figures are given in million of shillings. So we will also work with our figures in million of shillings. In million of shillings like that. In million of shillings like that. Yes. So that is how we arrange our work whenever we are computing the temporary difference. So I want us to go straight to note number 1. In note number 1, what are we told here? We are told the company has available for sale financial asset with a carrying amount of 80 million and financial asset at fair value through profit and loss of 40 million. So in that case, we are given two types of financial assets. Remember in our previous topic, the topic of financial instrument, we defined what are financial assets. Financial asset, we said, is a contractual right to receive cash or to receive equity instrument. Generally, we said financial asset is investing in shares or investment in shares, investment in debt instruments. So therefore, in that case, we have two types of two financial assets to be more specific. So the first one is called available for sale financial asset. But if you can be able to recall in our previous topic, we didn't come across this available for sale financial asset. Now, but there is something I mentioned that financial assets were previously classified using IAS 39, which has already been scrapped and superseded by IFRS 9. So one of the classification of financial asset under the old standard IAS 39 was financial asset available for sale. But this financial asset available for sale, this currently what we refer as the financial asset at fair value through other comprehensive income. And I hope you can be able to recall, we say that this is investment in shares and the company intends to retain the ownership of those shares for a long period of time. So therefore we say this is an uncurrent asset. So we are given information about this, and also we are given information about financial asset at fair value through profit and loss. We also talked about this investment in shares for speculation purpose. Now, what basically we need to do as far as these two financial assets are concerned is to determine their carrying amount and the tax base. Now, you have to recall what is carrying amount. Carrying amount, we have said, is the value at which an asset or even a liability is recorded in the balance sheet, in the statement of financial position. Tax base is the value of an asset or liability for tax purpose. So, for example, whenever the company sells this financial asset and the company wants to determine the amount which is to be taxed, so which value does the company use? Yes, that value the company uses in computing the amount to be taxed is the tax base. Ordinarily, these particular questions for deferred taxes, usually the challenge is here. Determining the tax base, because mostly the carrying amount will be provided. So what the examiner in most of the cases will not give you is the tax base. But in this case, I'll be able to show you how to determine the tax base for various items of asset and liability. So as far as these two financial assets are concerned, in number 1, we are told the company has available for sale financial asset, which is also known as which is currently known as financial asset at fair value through profit and loss, through other comprehensive income with a carrying amount of 80 million. We are given the carrying amount here, 80 million. With a carrying amount of 80 million and a financial asset at fair value through profit and loss of 40 million. That 40 million is also carrying amount. So in our case, you're given the carrying amount for these two financial assets. Then we are told then in the last paragraph, both of them, both financial assets reported losses in their fair value of shillings, what? 8 million as at the end of the year. Now recall what we said in our previous topic of financial instrument. We say that this particular financial asset, they are recorded in the company's balance sheet at their fair value. At their fair what? Value. Automatically, these are fair values. These are what? Fair values, their current market value. But now how do we determine the tax base? These are some of the notes which are important moving forward. The tax base, not that, yes, the tax base. A tax base of financial assets at fair value through other comprehensive income and financial assets through profit and loss is always the cost. Is always the cost. So this particular financial asset were acquired at which cost? So the cost paid by the company in acquiring those financial assets is the tax base. Is the tax what? Is the tax base. So therefore, this is what is important for you to know moving forward. Anytime you're given a financial asset, you want to know its tax base, then you need to ask yourself, how much cost did the company pay in acquiring this financial asset? And actually, in our case, what you're given here, we have said that these are the fair values. Fair value is the market price of this particular financial asset at the end of the year. But in the last paragraph, we are told both of them reported losses. It basically means that, for example, this one, its value reduced. Its value did what? Reduced. Its value reduced because if at the end of the year it has a market value of 80 million, then this had reduced, or basically we are told this had reduced with how much? 8 million. So can we be able to know how much cost was paid by the company in acquiring this financial asset? Can you be able to know? Can you be able to know if its market price at the end of the year was 80, but its value had reduced with 80? Can you be able to know the value at which it was acquired at? Yes or no? I'm told by Aziz it will be 88. Can you be able to know the cost? Can you be able to know the cost? Yes, we can be able to know the cost. To determine the cost here, we will take this fair value, its fair value at the end of the year, which has reduced with 8 million, and then we add 8. We add 8 because its market value at the end of the year was 80 million, but taking into account its value had reduced with 8 million, it basically means that the company had bought this financial asset at how much? 88 million. So therefore, the tax base here being now equal to the cost incurred by the company in acquiring this financial asset will be 88. The same case with this one. Because it also reported a loss of 8 million, the cost incurred by the company was what? Was 48. So therefore, this will be 48 million. And then we need to determine the temporary difference. Temporary difference, this one, which will be equal to carrying amount, whatever you have here, minus tax base, this one. So we take this minus this. So this minus this, which will give us -8 because we take carrying amount minus tax base. So carrying amount is 80 million minus 88. This will give us -8. Now, what is also important for you to see here, or for you to note here, is that the tax base here is more than, this one is more than carrying amount. If you can remember what you have just discussed, we have said that if you get a carrying amount, or if the tax base that is more than carrying amount, then you have said that temporary difference is deductible. Is what? Deductible. Or in other terms, you don't even need to cram that. So once you get a temporary difference here, which is negative, then that is deductible temporary difference. But if it's a positive, it is a taxable temporary difference. So therefore, these are negative, therefore it is deductible. The same case, 40 minus this, -8, which is a negative, and that is the deductible temporary difference. So therefore, that's how we determine this one. So moving forward, this information is very important. Tax base of this financial asset is always equal to the cost, and also now the carrying amount. Their carrying amount is equal to the fair value. Their carrying amount is equal to the fair what? To the fair value. So let's move to point number 2. In point number 2, we are given something to do with the inventory. It is also important to note that whatever you have dealt with here is an asset. This is an asset, and also inventory is an asset. Now, we are told inventory is shown at the row of cost and net realizable value. The cost is 32, whereas the net realizable value is how much? Is 31.20. I also need to give a note as far as inventory is concerned. And what you have to recall from financial reporting and analysis, inventory is always valued according to IAS2. Whenever the company is determining the value of the inventory, that is governed by International Accounting Standard number 2. And actually, the value of the inventory, according to this standard, is always taken to be the row of cost or the net realizable value. So the role of these two values is the value of the inventory, and that is the amount at which the inventory is recorded or recognized in the statement of financial position. Because inventory, generally we are referring to the closing inventory, is a current asset. Is a current what? Asset. So if you check on whatever you're given here, we're given the cost, this one, which is 32, and then the net realizable value is given as 31.20. So the role of these two, the role of the two will be the carrying amount. The inventory is recorded in the statement of financial position as the role of the two. So the role of the two is what? We take the figure which is lower than the other one, which is 31.20. So when the company is preparing the statement of financial position, the inventory is recorded there at the role of the two. That is in accordance with IAS 2. But now, what is the tax base? What is the tax base? Now, we know the reason as to why a company will be having inventory or some goods not yet sold at the end of the year or maybe at the end of the month is because the company made purchases. And actually, if you can also be able to remember from what you did in PFT, we know purchases is allowable expense, is allowable or deductible what? Expense. And therefore, the tax base of inventory is always equal to the cost of the goods now which were purchased. So in other terms here, we can say that the tax base of inventory is therefore equal to the cost. Is equal to what? To the cost. So tax base is equal to the cost. What is the cost here? The cost is what? 32, because this what now was treated as allowable expense. This is the value which was taken into account in computing the taxable what? Profit for this year. So therefore, the tax base is always equal to the cost. Always equal to the cost. Sasa? Yes. So then we get the difference. This minus this one, which will give us what? The difference is what? Yes, the difference is 80 million. And I think this is still a negative. These are still a negative, which is deductible temporary difference. So let's move to the other point, number 3. Number 3. And you're given information about receivables. So for the receivables, we are told they had a carrying amount of 2,000. So we already have this one, carrying amount of 2,000. And we are told after making allowance for doubtful debts of 80 million and exchange gain not yet realized of 160 million, we are told both allowance and exchange gain are not allowed for tax purpose. I'll also give a note in relation to that. And actually, this applies to receivables and also payables. Receivables and payables. So how do we determine the carrying amount, the tax base of these two items of working capital? So tax base in this case is always equal to the gross amount. The gross what? Amount. What is the gross amount? It is the original figure of the receivables or payables before making any adjustment. Before making any what? Adjustment. So the original value before making any adjustment. So for example, talk about your gross salary. Basically, this is your total salary without deducting any statutory deduction. Yes, so that is what is important. What about the carrying amount? So these items of receivables and payables, they are recorded in the statement of financial position at which value? They are recorded in the statement of financial position at the net amount. Net amount is the original figure, and then you make various what? Adjustments. So let's come back to this now, having that knowledge. So therefore, whatever you're given here is the carrying amount, automatically this is the net amount, the number of adjustments which have been made. How do we determine the tax base? We need to determine the original value for the receivables. The original value for what? For the receivables. So what are we told here? We are told the receivables had a carrying amount of 2,000 after making a provision for doubtful debts of 80 million and exchange gain of 60 million, which is not yet realized. So in fact, we can just ignore the last paragraph. So meaning that in arriving at this particular figure of 2,000, there are two items which were adjusted here. One of it is allowance. The allowance for doubtful debts of how much? Of 80 million. Of 80 million. And actually now you need to ask yourself, in arriving at this particular figure here, how was this allowance for doubtful debts adjusted? So allowance for doubtful debts, we know, is money which is set aside to cater for those particular debts which will not be paid in future. So therefore, in arriving at this figure, usually the allowance will have been deducted, or actually the allowance was deducted. So that means that in arriving at this figure, 80 million was deducted. And then we also told that there was exchange gain, or basically there was an realized exchange gain, of 160. So when talk about an realized exchange gain, this is basically an exchange gain which the company has not yet received. Which the company has not yet received. Is basically like an income which you have not received. So if it is an income you have not yet received, you account for this as a current asset, or you account for this as part of receivables. Is an income you have not yet received. So therefore, in arriving at this amount here, take into account this an income not yet received, it was added. It was what? It was added. Sasa? Yes. Now, having such knowledge, we need to ask ourselves, what now will be the tax base? Tax base is the gross, original figure. So this figure 2,000 is the net. It has been adjusted with these two items. How do we get the original figure for receivables? To get the original figure for receivables, we are going to take this 2,000, and then this 80, which has already been deducted, we do what? We add it back. This 160, which has been added here, we do what? We less it. That's basically how we arrive at the original figure for receivables. So therefore, the original figure for receivables will be 2,000 plus 80 minus what? Minus 160. So this will give us a final figure of what? A final figure of what? A final figure of what? Of 1920. And I think I'm only getting answers from Yvonne. I'm not getting answers from Aziz, Dan, Faith, Lucy, Caro, Moha. I'm not getting answers from you. So it's also good to share your answer in the chat box. Once you get the answer, just type it in the chat box there. Just type it in the chat box. I'll be able to see it. Are you getting 1920? Are you getting 1920, 1920? 1920, 1920, 1920. Yes. So therefore, we get the difference, this minus this, which will be 80. And this is basically now a positive figure. So this is a taxable temporary difference. We have said if you get a negative figure, is deductible. If you get a positive figure, is what? Is taxable. Equally, whatever you have dealt with here, that is also an item of assets. So let's move to the other point, which is point number 4. And point number 4 there, we're given information about the trade and other payables. trade and other payables, trade and other payables, and other payables. Now, for the trade and other payables, or actually payables, the concept of determining the tax base and the carrying amount is similar to that of receivables. So what are we told here? We are told trade and other payables are stated at 36. Stated where? Stated in the statement of financial position. So if they are stated in the statement of financial position at an amount of 36, then that is the carrying amount. And also it is important to note that payables is a liability. Unlike the first 4 items you have dealt with, is an item of liability. The reason why it is important for you to know whether it is an item of asset or liabilities, I'll be able to explain here. So, and then you're told this 36 is after making provision for discount of 40. So remember, how do we determine the tax base of both the receivables and payables? The tax base is always equal to the gross amount, the original figure. So in arriving at this figure here, we are told the company had made a provision, basically a provision, like a provision for discount to be allowed is always deducted in arriving at this. So in arriving at this, the company had deducted what? 40. So how do we get the original figure? For payables, to get the original figure, we add back what? 40. We add back 40 because the tax base is equal to the gross amount of the original what? A figure. So therefore, this one would be 36 what? 40. 3640. Yes, that's how we determine the tax base. Now, also take into account this is an item of liability. When recording an item of liability here, we record both values here as negatives. Both values as what? As negative. Because by the end of the day, once you have computed these temporary differences, we will come and we get net amount here. So the temporary differences for assets should be like positive, and then those for liabilities should be negative. Or in other terms, what is important to know is that when recording an item of liability, record both figures as what? Negative. And then how do we compute this one? To compute the temporary difference, we take whatever you have here, which is negative 36, this one, minus this. So this is negative 36 what? 40. I hope you can see what I've done. I've taken negative 36 minus negative 36. So therefore, we're going to have negative 36. A negative and a negative becomes what? A positive 3640. So this will give us what now? That will give us what? That is how we deal with an item of what? With an item of liability. So I'm told this will give us 40, which is basically positive. And therefore, this is taxable. That is taxable temporary what? Difference. Taxable temporary difference. Taxable temporary difference. Let's move to point number 5. Point number 5, we have property, plant, and equipment. You have to recall that property, plant, and equipment is comprises of all tangible and current assets, buildings, land, plant, and machinery, and so on. So we are told PPE had a carrying amount. Carrying amount is already given here, 48 million, and tax base of 4,000. Tax base of what? 4,000. And then you're told some land and buildings were revalued upward is 2,000 during the year. I'll be able to explain what is how we use this revaluation gain, but basically that one we don't use it here. I'll be able to explain how we use that one specifically in answering Roman 2. We don't use that in computing the temporary difference. So we take this minus this. It's also important to know this is an item of assets. So this minus this, which will give us 800, which is taxable temporary difference. Okay, finally, number 6. We have intangible assets. Intangible assets. This is basically an item of assets. An item of asset, and you're told intangible assets consisting of trade licenses being amortized over a period of 5 years had a carrying amount of 240. So carrying amount is already given 240, and then you're told this was allowed for tax purpose in full 2 years ago. So I need to give a note for that, because this is also something you'll come across in some other questions for deferred taxes. So for intangible assets, usually intangible assets These are assets which arises from capitalization of expenditures. For example, a company may pay for a license, which will enable the company to operate in a country for the next 5 years. So if you pay a license, a huge amount, or basically you pay for a license for 5 years. So what you do, you can't recognize that expense in the income statement for the current year. What you do, that license which you have paid for the next 5 years, the amount you have paid, you capitalize it. You treat it as an asset. By capitalizing an expense means that that expense you're treating it as what? An asset. Specifically, you refer to it as an intangible asset, and then you amortize it in the next 5 years. You gradually rate it off in the next 5 years. Another expense which may be capitalized is something like development expenditure. The company is developing a new product. So the cost incurred is usually capitalized and then what? Amortized. So how do we basically determine now both the carrying amount and the tax base? Carrying amount, this one is equal to the cost minus accumulated amortization. That is how we determine the carrying amount. What about the tax base? Tax base is equal to amount allowable for tax purpose, amount allowable for tax purpose in the future. Amount allowable for tax purpose in the future. Amount allowable for tax purpose in the future. How much amount would be allowed or would be treated as allowable expense in the future? Now, for us to be able to get the to know this one, we have to go to the last sentence of note number 6, and you're told this amount was allowed for tax purpose in full 2 years back, 2 years ago. So when the company incurred these costs, when the company paid for this license, the cost now which was incurred was treated as allowable expense 2 years back. So then we need to ask ourselves for us to get the tax base. So how much amount will be allowed for tax purpose in the future? So and actually take into account from what you did in taxation. If you have a business, mostly a company, you have incurred an expense during the current year. You have treated that expense as allowable expense. Is it, or the taxman, can the taxman allow you to treat that particular expense again as allowable expense in the future? Yes or no? Will the taxman allow you to treat that expenditure again, or will you be allowed to treat that particular expense as allowable expense in the future? Yes or no? Yes or no? So I've said you have a business, mostly you have a company, you have incurred an expenditure of like 20 million during the current year, and then you have accounted for this as allowable expense during the current year. Now, will this expense be treated as allowable expense again in the future? Will the taxman allow you to do that? Yes or no? Will you be allowed to treat this as allowable expense again in the future? Automatically no, because what you want to do is to reduce the taxes you'll pay to the taxman in what? In the future. So therefore, we need to ask ourselves here, take into account this amount was allowed for tax purpose 2 years ago. Will it be allowed again as allowable expense again in the future? It is obviously no. And therefore, if a company incurred an expense which then was capitalized, but it has already been treated as allowable expense already, then the tax base is always equal to 0. So no amount which will be allowed for tax purpose, in what? In the future. So therefore, in this case, the tax base is what? Future. The amount allowable for tax purpose in relation to this license is what? 0. It has already been treated as allowable expense 2 years what? Back. Are we together? Yes. So therefore, we get the difference here, which is 240. And actually, that is a positive. And that is a taxable temporary difference. So I think we are done, because what you're given in note number 7 is all about the tax rate. So therefore, this is basically what was required, but we need to add all this so that now we get the net amount here. the net amount, of which now the net amount you're going to get here can either be net deductible or net taxable temporary difference. If you get a positive figure, is a net taxable temporary difference. If you get a negative figure, it is a net deductible. But automatically ours will be a positive. It will be a positive figure, which will be net taxable temporary difference. Net taxable temporary difference. So give me the net amount here. You add all this. Whatever is a negative, you take it as a negative. Whatever is a negative, take it as a negative. Yes, what are you getting down here? Yes, I'm getting a figure of 10,640. So this is what was required in part A, because you are required to compute the relevant temporary difference. So the 8 marks were basically allocated for this, computing those temporary differences. Now, having that, we can proceed and we answer Roman 2 of that particular question, whereby you are required to make the journal entries to record the changes in deferred tax. And even before we move now to Roman 2, these particular notes which I've given here are very, very important. You'll be able to see how they'll help you even when answering the other words questions. So let's move to Roman 2 now. Roman 2, where we are required to make the relevant journal entries to record the changes in deferred tax. Roman 2, relevant journal entries. Okay, that is journal entries to record changes in deferred tax. To record changes in deferred tax liability, deferred tax liability. And now, for us to be able to make these particular journal entries, there is something I want us to do first of all. I want us to prepare something called the deferred tax account, because by preparing that deferred tax account, we'll be able to see some of the items which made the deferred tax to change. Because I hope you can recall, in paragraph 1 of this particular question, we are given the deferred tax liability at the start. And also, we will be able to use this particular figure which you have computed here to compute the deferred tax at the end of what? Of the year. So which items caused that deferred tax to change? So for us to be able to know those items, let's first of all prepare the deferred tax account, and then we make those particular journal entries. So we start by preparing the deferred tax account. Deferred tax account. Deferred tax account. So in this particular deferred tax account, what do we record? We're going to start by recording the first item, which are given in paragraph 1 of this question, and that is the deferred tax liability at the start. Deferred tax liability at the start. Remember, these are ledger accounts. This is the debit side, this is the credit side. So take into account at the start of there was a deferred tax liability. We know all liabilities have a credit balance. So we start by recording the opening balance brought down on this side, which is 400 million. The reason why we're recording it on this side is because it's a liability. And actually, we know all liabilities have a credit balance. Then at the end of the year, recall, we have been able to compute this amount of temporary difference. And actually, this is now what we use to compute the deferred tax asset or the deferred tax liability at the end of the year. Remember, we have said that this is a net taxable temporary difference. So if you can remember in our introduction, we said that a taxable temporary difference a taxable temporary difference, this gives rise to something called the deferred tax liability. That's what we said. Taxable temporary difference gives rise to amount taxable in the future. In other terms, it gives rise to deferred tax liability. So therefore, what we need to do here is to compute the deferred tax liability at the end of the year. So let's compute the deferred tax liability at the end of the year. And actually, this year ended on which date here? It's ended on which date? 30th of September 2019. We are given that information in paragraph 2 when the year was ending. So how do we compute this deferred tax liability at the end of the year? So we are going to take net taxable temporary difference, or just the taxable temporary difference. We multiply that with the tax rate. This is a formula which I've already given you, how to compute the deferred tax liability. So the deferred tax liability at the end of the year will be equal to this one, 1064 times the tax rate. Tax rate is given in note number 7, 30%. 30%. So that will give us a deferred tax liability of how much at the end of the year? So the deferred tax liability here, I'm told by Aziz, will be 319.2. 319.2. That is also the answer I'm getting from Yvonne. Now, this, therefore, is a deferred tax liability at the end of the year. So being a deferred tax liability at the end of the year, where do we record it in our account here? And actually, this is something you have to recall from the basic knowledge of accounting. So when preparing the ledger accounts, so up here we record the opening balances. Down here we record the closing balances. So take into account these are deferred tax liability. We record the balance carried down on the debit side here, on the debit side, which is 319.2. So the reason why we record it on this side is such that once you have balance this account, automatically you bring down this balance. So any balance, you bring it down on the direct opposite side. So the balance brought down will be a credit balance. And actually, we know all liabilities have a credit balance. Sasa? Yes, but if it was a deferred tax asset, we record the balance carried down here, and then you bring it down on the debit side. Now, other than recording the opening balance and the closing balance in this account, what else do we record here? What else do we record here? There is something I need to explain in relation to note number 1, in relation to note number 5. Note number 5 and also note number 1, and that is something known as the fair value adjustments. The fair value adjustment of financial assets at fair value through other comprehensive incomes, and also revaluation of PPE. Revaluation of PPE. There is something I said I explained in relation to note number 5. Yes, so fair value adjustment for this financial asset and also PPE. Now, let's first of all talk of revaluation of PPE. So basically what we know from whatever you covered in financial reporting, if the company has some items of PPE like land and buildings, those assets may be revalued. The company may be using the fair value model, whereby at the end of each year, those assets are valued at, are supposed to be revalued to their fair value. And actually that revaluation gives rise to a revaluation gain or a revaluation loss. The same case, we have said that this particular financial asset at fair value through profit and loss, generally they are recorded in the statement of financial position at their fair value. So at the end of each year, IFRS 9 requires an entity to determine the fair value of this particular financial asset, of which that may give rise to a revaluation gain or a revaluation loss. So mean that once these two assets, PPE and these assets have been revalued, then that can give rise to a revaluation gain or can give rise to a revaluation loss. Revaluation gain or revaluation loss. Now, basically what we say is that this particular revaluation gain or revaluation loss, this one only affects the carrying amount. For example, if the company had acquired a building at 20 million, in taxation, we use 20 million in computing capital allowances. But for example, if this building has been revalued, then the amount at which this building is recorded in the balance sheet will keep on changing. So therefore, anytime assets have been revalued, that's only affect the carrying amount, but it does not affect what? The tax base. And therefore, that revaluation of these two assets give rise to a temporary difference. So therefore, what is important for you to know here is that in case any of these particular assets are revalued, and basically there is a revaluation gain, so what we do is that we use this particular revaluation gain to compute something called the deferred tax expense. We use this one to compute the deferred tax expense, and actually we can refer to that as deferred tax expense on revaluation gain. Deferred tax expense on revaluation gain. So how do we compute this one? Deferred tax expense on the revaluation gain. So to compute this one, we take the revaluation gain times what? Times the tax rate. And then how do we go ahead and account for this one? How do we go ahead and account for this? So accounting entries. Accounting entries basically is the double entry. So this one is accounted for by debiting the revaluation reserve account, and then crediting the deferred tax account. Crediting the deferred tax what? Account. Yes. But on the other hand, in case any of these particular two assets have been revalued and there is a revaluation loss, we compute something called the deferred tax income, on revaluation gain, on revaluation loss. And this one is computed by taking the revaluation loss times what? Times the tax rate. So just what is important for you here is to remember this. In case of a gain of these two assets, compute deferred tax expense. How do we account for that? Debit the revaluation reserve account, credit deferred tax. So, and then in case these two assets were revalued, there was a loss, compute deferred tax income. How do we account for this? The accounting entries. So we just reverse this one. So we debit deferred tax account, and then we credit revaluation reserve account. Now, with this particular knowledge, now I want us first of all to go back to note number 5. Note number 5, specifically note the last sentence of note 5. What are we told in note 5? Some landed buildings were revalued upward. So being revalued upward automatically, that is a revaluation gain. Were revalued upward by shillings 200 million during the year which ended 30th September 2019. They were revalued upward, meaning that there was a revaluation gain of how much? Over 200 million. So now take into account this revaluation gain on PPE, then we need to compute something called the deferred tax expense on that revaluation what? Gain. How do we compute it? We take our gain, which is 200 million. We multiply that with the tax rate, which is 30%. So then how do we account for this amount which you are going to get here, which is a deferred tax expense on the revaluation gain? So we debit the revaluation reserve account, but we are not preparing that account here. So our main interest is this entry here. We credit which account? We credit deferred tax account. So therefore, this account will be credited. I hope you can see that. Will be credited with with we can just refer to that as the deferred tax expense on a PP revaluation gain. How do we compute this one? I've said to compute this one, we take 200 times 30%. So which automatically give us what? 60. So that one is supposed to be credited in this account. It's supposed to be credited in this what? Account. Then you also need to check whether this asset was revalued. And remember, in our question, we don't have this asset, but basically, previously I've said that these were known as AFS, available for sale financial assets. And actually, this only apply to financial asset at fair value. This concept of accounting for deferred tax expense, deferred tax income on evaluation gain or loss, it does not apply to any other financial asset. It only applies specifically to this one. To this what? Financial asset. Not to the financial asset at fair value through profit and loss, not to financial asset at amortized cost. Sasa? Yes. So because in note 1 we have two assets, we will only consider one. Financial asset at fair value through other comprehensive income, which is also known as what? AFS. Now, in note number 1, let's go back to note 1. Specifically, sentence 2, we are told both financial asset reported losses in fair value of 2 million. So if asset reported losses, it basically means that there was a revaluation loss. That is a revaluation loss. Specifically, we are dealing with the revaluation loss on AFS, which are currently known as what? Financial asset at fair value through profit and loss. Now, in case this asset therefore was revalued, there was a loss, we have said compute deferred tax income on that loss. How do we compute that one? We take the loss, 8 million times what? The tax rate, which is 30%. How do we account for this figure here? In the deferred tax. In the deferred tax. So in the deferred tax account will be what? Will be debited. So we come and debit this account here. And basically this now will be the deferred tax income on deferred tax income on AFS, or basically financial assets at fair value through other comprehensive income revaluation loss. How do we compute this one? The loss, 8 million times what? 30%, which will give us 2.4. 2.4. Yes, so that's basically how we prepare that account. And then finally, what we do, we balance this account. This account, we balance it because I hope you can see we already have a closing balance here. So the balancing figure is not a balance carried down, but the balancing figure is taken to the income statement. If we have a balancing figure on this side, we refer to that as a deferred tax expense, which will go to the income statement being the balancing figure. If we have a balancing figure on this side, it is still taken to the income statement, but is known as a deferred tax income. Is known as a deferred tax what? Income. Automatically, you can't have both. You can either have a deferred tax income or a deferred tax what? Expense. So this side is for 60, and then this side is less. Automatically, the balancing figure will be on this side. So we will have 460, 460. And then to this 460, what do we need to less? We need to less 2.4. We also need to less 319.2. And I'm getting a balancing figure on this side of 138.4. 138.4. Yes. So that's basically the balancing figure now. And I think having this now account, you can see that this particular deferred tax at the start of the year, or our deferred tax expense, the deferred tax liability at the start of the year was this one, but at the end of the day is this one. So that deferred tax liability has changed due to these three items: this one, this, and this. And now we need to make the journal entries for those items which cause the deferred tax liability to do what? To change. I think we can start making a journal entry for this. And what is this? This number 1 is the deferred tax expense on PP revaluation what? Gain. So what is the journal entry? Journal entry, remember, is the double entry. Which account should be debit, or which account was debited which account was credited with this particular amount here. So you can see this account is credited, but I hope you can remember the double entry here. So we debit the account called what? The revaluation reserve, we credit deferred tax. So therefore, we say that the journal entry for this is we debit the revaluation reserve account, account with 60 million, and then credit deferred tax account with how much? With 60 million. That is the journal entry, the double entry for this. Then we need to make journal entry for this and this. Let's start with this one. That is what is this? This is deferred tax. Deferred tax income on available for sale revaluation what? Loss. Revaluation loss. Revaluation loss. And actually, this is the double entry here. This is the double entry for the loss. Where do we have that? This is the double entry. So this account you can see is debited. So we debit deferred tax account. Debit deferred tax account with an amount of 2.4 million. 2.4 million. And then we credit which account? The revaluation reserve. Revaluation reserve account 2.4. And then finally, we also need to make a journal entry for this deferred tax income for the current year. So we make a journal entry for deferred tax income for the current year. For the current year. And actually, the current year, if you can recall, ended on that year of September 2019. That is when the current year ended. So therefore, what do? We debit this account, debit deferred tax account 138.4, and then we do what? We credit. We credit, the other entry will go to the income statement. We credit deferred tax, we credit income statement, or basically statement of profit or loss with the same amount. 138.4. So this now what was required as far as that Roman 2 of the question is concerned, basically preparing those particular journal entries, preparing those journal entries.